G'day everyone. Thanks for joining us today for our Netwealth Practice Management webinar, our series designed to help wealth professionals discover new opportunities to enhance their businesses. My name's Nick Mitchell. I'm Head of Distribution here at Netwealth. Very happy to be with you today. Been a massive month and highly significant for our entire industry, with Commissioner Hayne delivering his final report just over 4 weeks ago now. To examine how these findings could impact your business, we're very lucky to have Dante De Gori, CEO of the FPA, the Financial Planning Association of Australia, with us. A few things to note: there's a CPD point allocated for attending this webinar. To receive this CPD point, you'll need to complete the feedback survey that'll appear at the end of this session. The CPD details are then going to get emailed to you within the next week. Now, if the survey doesn't appear, just let us know. We'll confirm if you've attended this webinar and include you on the email. It is being recorded today. You'll receive a copy of this session along with the slides in the CPD email. If there's anything you'd like to ask Dante today, you can do so by the question tab in the toolbar, which is at the right of your screen. And if you're so inclined, you want to share anything about this webinar on social, we ask you to please include hashtag NetwealthInvest or @NetwealthInvest. Before we jump in, just a little bit about who we are. Can you believe it, nearing our 20th year? Netwealth, we're an ASX listed company who provide an online platform to support financial advisors with a wide range of financial products and services to help their clients manage investments and super. Some of our key features include we're a market leading advisor and client portal that's intuitive and really easy to use. Our new mobile app to help you and your clients access key info on the go, a wide range of investment options, and a suite of detailed reports that can be tailored to your client and business needs. Now it's on to our speaker. I've got the pleasure of introducing Dante De Gori, the CEO of the FPA. A proud CFP professional, Dante is extremely passionate about advancing the financial planning profession, supporting FPA members through change and building widespread consumer trust. Today, he's your webinar host. So with that, please take it away, Dante.
Great, thank you very much. Thank you, and thank you to Netwealth for inviting me to be here today to present and to speak to you all. And I believe we've got a lot of people online, so I really appreciate that. Today I've got an agenda that I want to go through, and hopefully I'll be able to get through most of this presentation, but as mentioned, we'd love to be able to take some questions and speak to you at the end of the presentation. My objective today is to really go through my view of the Royal Commission report, some of the recommendations that I believe are going to have an impact on financial advice and financial planning businesses going forward, and where things are at in terms of those recommendations, because we need to remind ourselves as well, this is a report and a recommendation from the Royal Commission. It isn't legislation as yet. So where things are at. And also briefly, there are other areas of reform that are related to the Royal Commission that I'd like to just quickly provide an update on in terms of the education standards and the role the FPA is going to provide in helping everyone across that transition. Just some opening comments from me. I think it's really important that we also need to consider that these reforms, the Royal Commission itself, and the constant, I suppose, or it feels like definitely the constant number of inquiries and scrutiny of the profession is definitely something that we need to be mindful of. And for many of you, it is almost some form of fatigue, and it also does create some uncertainty about what the future is. But I want to be quite clear from my perspective that the future is very positive. And I think the opportunity for the profession in respect to these changes is going to mean a positive outcome for financial planning. It's going to be very important that we look at the opportunities around this, as well as understanding what the pathway is, and obviously, where possible, ensure that there are workable and practicable pathways that actually lead to benefits and outcomes, not only just for the profession, but of course, for the end consumer and the Australian public more broadly. So that's really important. And so for me, as you can see on the slide there, I talk a lot about financial planning being of national importance. Financial planning is needed more than ever. The Australian government and the economy needs financial planning. With an ageing population, a large superannuation pot, an ever-growing superannuation pot, and a retirement pot of monies, people need advice. Australians need advice. So, and financial planners are the best equipped place to do that. Technology is obviously a constant, has been a constant over the years in terms of what role technology will play. I think interestingly and I think happily as well, technology is going to help be an enabler for financial planning as opposed to replacing financial planning. And I think that's really important. So we need to know how best to use that going forward, and that's an ongoing evolution for the profession. The other part of the profession, of course, is the next generation, and the FPA continues to work very closely and heavily with the university sector and the next generation of financial planners, which will be your future pipeline of advisors in your practices, but also your succession planning for your businesses as well. So that's really important. The education reforms and the reforms in general mean now that it is going to be more difficult to become a financial planner, but that is a good thing, trust me, going forward. And of course, all of this we want is because of respect, recognition of the profession. We all want to be respected as a profession of financial planners. Now, it's really important to note here when I talk about this that it's about the whole group of financial planners and advisors being respected as a profession, not about you individually being seen as a professional. This is really important. And of course, those of you that can find your way through these reforms and changes, I believe will be better off and will find some great benefits following the end of this reform process for your business, for you personally, and of course for your clients. Just a bit of an overview of the market. I think this is really important because there's a lot of misunderstanding, I think, about who owns who and the number of advisors and things like that in the marketplace. Now, these numbers are the official numbers that have been reported in the Royal Commission and Productivity Commission reports. I think it's important to note. And there's obviously some updates to these numbers as well that I'll talk about. But according to the ASIC register as of the 1st of April, there are 25,386 financial advisors registered in Australia. So that's every single person that's actually authorised to provide some form of personal advice in this country. And that was a 41% increase from the Ripoll or the Storm inquiry that was done by Bernie Ripoll. Interesting to note that 41% I think is a little bit misleading because back then there wasn't a register which could actually count the number of advisors in the country. Many employed representatives weren't listed anywhere, and so that number was always a difficult number to measure by the regulator, but now that's fully disclosed. Interestingly as well, there are about 5,800 licensees. 4,000 of those 5,000 provide a licensed or authorised by personal advice. That's a lot of licensees that the regulator is meant to be supervising, monitoring in the country. There are 6 financial institutions, the 4 major banks, AMP and ILF, that have over 35% of the advisors operating under their license or control. This number, I believe, is changing rapidly as we speak, but that was the number back then in terms of about a year ago. 30% of financial advisors work for the major banks, and the majority of financial planning firms have less than 10 financial advisors. And I think that's obviously a representation of the fact that there are a lot of licensees in the marketplace, and the average number of financial advisors per license is 34. But of course, that's skewed by the fact that there are a small number of large licensees. Since then, I think it's important to note that there are now about 28,000 people, individuals on the financial advisor register, and that number inflated basically in the last few months or the last quarter of 2018, and so about 4,000 additional individuals have been added to the register, and that has primarily been as a result of the education reforms, where the cut-off date to be treated as an existing planner versus being treated as a new planner was 31 December 2018. So that's understandable, but it's inflated those numbers quite significantly. Whether or not we will have 28,000 at the end of this process, of course, that's a lot of speculation about that at the moment around what those numbers will be. But at the moment, it currently sits at 28,000. Of course, there's a lot of changes in the marketplace in terms of what the banks are doing with their advice businesses. And this interesting point here, just to add a bit of a context, that the financial advice sector is worth about 4.6 billion in revenue, and this was reported by the Productivity Commission. That was back in 2015-16, so a significant portion of the economy. Bit of an overview here. I think it's always interesting to know where we've come from to where we're going, to help us understand where we're going. And this diagram here just shows the amount of activity pre-FOFA, which effectively was restricted down to about 3 or 4 key items pre-FOFA, which obviously resulted into the Financial Services Reform Act that we currently have. But since then, there's been a whole host of reforms, obviously led off by FOFA, which has triggered off a significant number of changes to the financial advice space, either directly or indirectly. And I think that's really important because all the changes around superannuation and other areas, tax, etc., have an indirect impact, of course, in financial planning in terms of the advice you provide. So unfortunately, it has been a constant change, is a constant. It's not new what is happening today. And this is a bit of a timeline around the legislative reform that has occurred, obviously pre-Royal Commission. So this is actually inquiries and reform that has enacted into actual sort of legislation, and no doubt that's going to continue. But as you can see there, as highlighted, the point there is there's been constant activity and change. And one interesting stat that I wanted to share with you is that since the Future Financial Advice reforms, there have been effectively 54 separate reviews, inquiries into either directly or indirectly into financial advice. So this is reviews and inquiries into particular bills or legislation, as well as more substantial reviews like the Financial System Inquiry and, of course, the Royal Commission. So, advice is definitely much being captured under scrutiny on a whole range of fronts when it comes to inquiries into financial services more generally. This slide just really is about honing in, I suppose, where the areas I think of real interest and that you should be interested in. This is about informing, being aware, and not being alarmed, but being aware about the different areas of reform that will have an impact on financial advice. And I'll start off with retirement. Retirement policy is huge and is actively being debated and discussed at the moment with Treasury. Many of you would have heard about the advice covenant, the retirement covenant. Also in PD days and conferences, I know that there's been many talking about this at the moment, to being aware that there are going to be changes afoot around retirement income policy. There's a strong swell for new types of products to come in, which you may have heard, acronyms around CIPRAs, comprehensive income stream products, which effectively are designed to help deal with longevity risk issues. So, there's a big debate about the role of those products, whether they should be mandated, the role of advice. And in our view, of course, is imperative that advice is provided to those consumers around entering those products, and they shouldn't be mandated into those products. We have to keep a close eye on those. Of course, the Royal Commission will go into more detail. Business models, as I mentioned, is changing. We need to be aware of that. The structure and shape of the profession going forward is going to significantly change and is changing right in front of our eyes at the moment. Whether it's people going into individual licensing, whether it's the banks getting out of advice businesses, and the emergence of more bigger advice firms as a result of that. AFCA, which is the new complaints authority taking over from FOS, that's in play now. It's a massive beast. It is huge in its operation, and it's just been handed more powers to look retrospectively on complaints over the last 10 years. And it's also been handed the role of working out how to run the last resort compensation scheme, which has been recommended by the Royal Commission as well. A Productivity Commission, there's been a number of Productivity Commission inquiries into the sector, in particular superannuation and competition into the financial services sector. Interesting recommendations here that I just wanted you to be aware of. One is around the fact that advisors who are providing advice, obviously, would need to go and get a separate Australian credit license or authorised credit representative to be able to provide advice on debt products. The Productivity Commission is saying that shouldn't be the case. Advisors, it should be built into their license. And I think that's a good thing because it obviously is removing duplication, red tape, unnecessary costs for the sector when it's imperative that financial advice considers and covers the debt obligations and needs of consumers. So that's an important recommendation there that we're pursuing as well and following that up. And of course, I think the recommendations around advice in general, which have now been carried on by the Royal Commission, which I'll go into a bit more detail. ASIC, important note here, there are changes afoot at ASIC quite significantly. So the Royal Commission, as much as we may obviously feel that there's a lot of scrutiny about advice, there was obviously a ton of scrutiny about the regulator and the role of the regulator through this process. ASIC have come out and there are changes afoot that are happening in respect to the role of the regulator. And a paper recently released by the regulator very much outlines the way they're going to operate going forward. And effectively, the line is, why shouldn't we litigate? Why not litigate? So they're going to be taking a more aggressive stance in terms of enforcement. And in fact, they've announced a new enforcement department within ASIC, which will be solely responsible for all enforcement action, and effectively meaning that ASIC is going to be separated into two parts. One being the regulator who interacts with the profession and provides regulatory guidance and tries to support the profession in meeting its obligations under the law, but they won't be in any way, shape involved in any enforcement activity. And this goes to the heart of the criticism around ASIC having a relationship with the sector and certain institutions. And so obviously they want to keep that relationship because it's beneficial in ensuring compliance and preventative measures. But what it means also is that there will be a department within ASIC that will have no relationship with the sector and purely be responsible for enforcing, and they won't be effectively communicating to one another. So there'll be clear silos or Chinese walls, if you like, within ASIC around the way that will operate. And finally, I just want to talk about Parliament and politics. So it's really important to note that, you know, as many of you would appreciate, politics gets in the way of reform sometimes, and sometimes can assist in reform. And at this point in time, is my view, of course, with an impending election, that, you know, politics is potentially going to be a dangerous point for us, because both sides of the two major parties are, if you like, really trying to outdo each other in terms of who could be harder and faster and stronger around these recommendations. That's not a good thing for us. And in fact, I've come out today in an opinion piece saying that perhaps we should have pushed for an extension of the Royal Commission so it avoided the election, as opposed to being caught up as part of the election sort of political agenda. In any case, we are where we are, and an election is needed in order for us to have a government in place to actually carry out this reform, because at the moment no action is actually helping, and it's all it is doing is leading to uncertainty. So, but unfortunately, we have to live with the politics that come with the territory. So, moving into the Royal Commission itself, there's a quote here by Commissioner Hayne, which I really wanted to share with you, because I had a personal experience, obviously, being on the stand at the Royal Commission, and one of the questions asked of me was whether or not the advice sector was a profession, and I made the comment that I believe it's an emerging profession, and I strongly believe that, and it's not to say that financial advice and financial advisors are not professional. That's not what I mean by that. And as I said back at my earlier commentary, this is about the way we are perceived as a group, as an occupation of financial planners by the Australian public. And I want to be very clear, this does not mean that individually you are not all professionals. You are absolutely all professionals, and your clients perceive you as professionals, and your advice firms are professional in the way they operate and conduct themselves. That is without question. This is just purely about the occupation of financial planning being perceived as a profession by the wider community at large. And the Commissioner's comment here is, or quote, is the financial advice industry is partway through the transformation from an industry dedicated to the sale of financial products to the profession concerned with the provision of financial advice. Now, I also should make the point that it is very clear and obvious that there are many components or parts of the advice sector today that are actually already transformed to the provision of financial advice, moved away from the sale of product. But unfortunately, it's also true to say that there's some pockets within our sector that are still led by the sale of product. And so that is the transformation that needs to be completed. Until we're all there, well, then we're not there. And that's the point here. We need to all get there at the same, we need to all be there together in order for us to be seen as a true profession. And we can, and we will. And that's part of the role that, that I think we're all playing at the moment. Interestingly, the Commissioner has said there are 3 key elements that need to be achieved in order to complete the transformation in his eyes. So what are they? 1, the big issue is dealing with this fee for no service. It was a massive component of the Royal Commission inquiries and has been, as many of you know, over a number of years, this issue of fee for no service. And it's a project that's been run by ASIC, especially with the larger institution, the banks and AMP, around the issue of fee for no service. Commissioner Haynes said is that effectively, if we can remove this issue of fee for no service, that's step one. Step two is reducing the conflicts of interest. And again, this is really important to note that you're never going to have a profession without conflicts. Every profession has them. I mean, even if you go to look at other professions that charge hourly billing, etc., you can definitely argue, and they're debating within their own professions about the conflicts that are alive with hourly billing, etc. So there isn't a profession that doesn't have conflict. This is not about removing all conflicts, but it's about reducing them, and it's also about managing them. So remember, we actually are permitted to operate with conflict. It's about actually managing those conflicts. And there are conflicts that exist in every single business model in the marketplace. So even those that meet, in my opinion, even those that meet the strict definition of independence under the Corporations Act still face conflicts. And there are different types of conflicts that exist. And of course, all the way through to those obvious conflicts around remuneration, etc. So, and ownership. So the conflicts there need to be reduced as much as possible. And then the final piece, which again, obviously I support and agree with, and in fact was one of the areas that the FPA got criticised on quite significantly in the Royal Commission, was the disciplinary system. And the criticism really is around, when you read the report, it's actually around the fact there isn't a cohesive disciplinary system. And this is because we do operate, as in the FPA operates under its own system, ASIC operates on their own system, each licensee operates on their own system, and there isn't a cohesive operation between all those parties to work together around discipline. So the introduction of a sort of a single, if you like, or coherent disciplinary system is paramount and something that we support and needs to be worked on in order for the transformation to occur. And I'll talk a little bit more about that throughout this presentation. So in terms of the actual recommendations made by the Commissioner, one of the ones that are fascinating for me is this review, 2.3 review, quality of advice success. And this really relates to the issue of, and if you think about some of the post-FOFA reforms, how they're operating, do they working? And in particular, what this one relates to is the issue of best interest, or the issue, I suppose, the success or otherwise of the best interest duty safe harbour steps that are in place today. And a bit of context here, there was a lot of debate when FOFA was being legislated about introducing a fiduciary obligation or duty on financial planners. And that then got changed to a best interest duty obligation, which then led to, the argument that, well, what does that mean? That principle sounds great, but what does it actually mean in practice? And hence, the safe harbour steps were introduced in the legislation to try and provide some clarity as to how you can meet the best interest duty. Unfortunately, what that's meant is that for many licensees, that's just translated into a ticker box compliance process without actually meeting, if you like, the best interest duty principle or the fiduciary principle, placing the client's interest first in all cases, always, all the time. And by ticking off the safe harbour steps, people were meeting the safe harbour steps, but not necessarily meeting their fiduciary obligations. The Commissioner has basically said, review it in 2022, but his preference is quite clear that he thinks the safe harbour steps should be removed. And I think this is going to be an interesting process to go through and to see where we land on that. But philosophically, I think a principle-based approach works. If we had a principle-based approach, we would be building case law and examples of best interest duty in practice anyway. Obviously, that was the fear, but I think that's where we'll go, and that's what we'll have. And we are starting to get now cases in the courts that are defining the definition of best interest, which will obviously help in better understanding what that means in practice. This recommendation for me also stood out. Disclose lack of independence. Now, it's probably safe to say, and I don't know exactly the makeup of each individual on the call, on the webinar today, but it's probably fair to say there would be a very small proportion of you in attendance that would meet the strict definition of independence under the Corporations Act. For those of you that don't meet the strict definition of independence in the Corporations Act, this impacts you. And basically what the Commissioner has said is that you need to disclose in a written statement to your clients and to your potential clients why you're not independent. You need to tell them why you are not independent or unbiased, and I think that's quite interesting. And this is not just something you would put in your FSG. This, the form of which this will be done is still yet to be confirmed. But it's interesting where this recommendation came from. And if you read the report, it's come from the experience that he's observed in the UK. In the UK, they have also two types of financial advisors. They have independent advisors, and they have what's called restricted advisors. Their definition, though, isn't based on remuneration. Their definitions are based on products. So in the UK, an independent financial advisor is someone who basically has an open architecture. In other words, has no restriction on products that he or she can recommend. It's not restricted by any APL in our context. A restricted advisor is someone who is restricted by an APL, irrespective of how big it is. If it's restricted by an APL, then they are restricted. In the UK, that restricted advisor has to provide a statement up front to their potential clients as to the fact that they are restricted and why they're restricted. So he's taken that concept and said, well, why don't those advisors who aren't independent, why shouldn't they be communicating and disclosing upfront why they're not independent? So basically telling your clients why you're not independent. So again, I think this is fascinating in terms of what this means in practice and what this will do in terms of motivating some of you to potentially meet that definition, because I know that for some, they're actually not far off from meeting that definition of independent. And so I'm just wondering whether that will in any way, shape or form influence that. But either way, keep a lookout for this one, because again, how this will be implemented is going to be very interesting. Now remuneration, which is the biggest one, I suppose, that many of you are concerned about, and rightly so, because there's a lot of uncertainty about what all this really means. First thing I'll point out, of course, is that under the remuneration position, there are a number of recommendations here that I want to go through, but they all, at this point in time, are recommendations. However, there is already on foot exposure draft legislation to enact some of these. Grandfather commissions in particular has been debated and talked about by the political parties, but there's also moves around the fees from superannuation also being legislated. So whether that will all happen before the election or not is unlikely, but it does mean that potentially on whoever wins the election, I mean, that could be something that will be carried through quite quickly post the election. So let me go through some of these in a bit more detail. So I'll start off with 2.1, which is the annual renewal and payment. Now, for some of you, it may be easy to look at this and say this is effectively bringing opt-in to an annual regime rather than it being done every 2 years. It effectively is, and it's bringing in almost the fee disclosure requirements as well as part of that into an annual regime, which, the FDS is annual, but it's bringing that into this one-off regime. And effectively, what's going to be required here is that you will need to provide an annual renewal as opposed to it being every 2 years. And you'll also need to, effectively, you need to get authority from the client to proceed with the charging of the fees, or the fees that you wish to continue charging. But also, you'll need to also get authority from them in terms of the collection of those fees. And that's really important to note here. So there's some number of questions that we've asked Treasury around this in terms of how this works in practice. Obviously, we want to repeal some legislation in this space as well, where there's duplication or potential duplication, such as the opt-in and the FDS requirements, if it's going to be superseded by something like this annual renewal process. And I think it's an opportunity to reset that process in terms of the annual renewal payment. So that's something that need to keep a close eye on. We're definitely keeping a close eye in terms of what that means in practice. But effectively, for many of you, and I know some of you operate this way with annual invoicing as an example, that's effectively where it's going. I should also point out that the Commissioner did stop short of where I thought he may go, which is to stop the ability to actually enter into fee arrangements for services to be promised and services to be delivered, where he may have chosen to go into a position where you can only charge for services actually delivered. And he hasn't done that. So what that means is that you can still enter into arrangements for services to be delivered, but you'll need to confirm at the end of the year what services actually got delivered. and what the client is therefore going to be charged as a result of it. So that's the concept, but you know, some of you may choose to move to an invoice, you know, for services delivered type approach, and there's nothing stopping you doing that on a monthly or quarterly basis. But again, a lot more details sort of come from this in terms of how it works in practice. 2.4, grandfathered commissions. So this one obviously is getting a lot of airplay at the moment, and again, I'm sure perhaps many of you on the webinar today will have difference in opinions as to this particular piece and what your thoughts are. So from an FPA perspective, I think, to put it, just to be very clear, the FPA supports the removal of grandfathered commissions, and I'm going to go through in a moment some commentary around that in terms of our policy position. But I just wanted to confirm that that's our current position, and we do support a transition of 3 years for that. What's important to note is what the Commissioner said and what both sides of politics have said. So the Commissioner said that the grandfather commission should be removed as soon as practical. He didn't say remove straight away. He didn't say remove. He didn't pick a date. The Commissioner just said as soon as practical. And the practical element of that recommendation is really, really, really important. Now, both sides of politics have come out with different dates. The government came out with 2021, and Labor's now come out and said, we're going to do it quicker and faster in 2020. Now, this is the bit that I'm obviously very disappointed with in terms of the politicking of this issue. You do need a transition because, as the Commissioner's recommendation says, it needs to be done as soon as practical, and the practical side is really important. And I just want to flip over to the next slide to explain what I mean by that. The FPA's principles here is that the change needs to be in the client's best interest. No client can be worse off here as a result of this change. So the legislation needs to ensure that investors aren't worse off. 2, commission payments are actually refunded to clients and not retained by the product provider. That's a condition of ours in order to support this change. And that, again, the legislation needs to ensure that that occurs. There's no point turning off commissions. Yes, it doesn't get paid to the advisor, but what's the point of the consumer still paying that commission? They've got no benefit as a result of this. 3, tax relief is provided for any adverse tax consequences. So again, the way in which this might be implemented could impact on adversely on the investor or client as a result. So therefore, there needs to be relief for that client. Centrelink benefits need to be protected. Again, the way in which this will be managed in practice could lead to adverse impacts from a social security perspective. So again, the consumer needs to be protected. And all exit fees should be banned. No one should be paying an exit fee because they've been forced out of a product as a result of legislative change and be charged for it. That's just ridiculous. So these are the principles that we are fighting for in terms of ensuring that the Grandfather Commission's legislation works. And that's what we mean by practical, and that's what we believe the Commissioner means by practical as well. He understands that the industry does need time to actually make this change. Now, there may be there's obviously others who disagree with that and believe it shouldn't change at all. I should point out that we completely respect and understand that there are a number of practitioners and advice firms who are invested heavily in grandfathered books of business, and they're the ones that do need the time to transition as well, to have any hope and chance of converting those clients into fee-for-service clients, and hence the reason why we support a 3-year transition to assist them in that process. And I know there's a lot of discussion and debate about whether it's constitutional or unconstitutional. Look, I'll leave that to the constitutional experts around that. I think the right question to ask is this the right thing to do, and is this what will help in the transition of us from an industry to a profession? The other recommendations that I want to talk about, life insurance commissions, which also is another hotly discussed item. And again, it's important to reflect on what the actual recommendation is from the Commissioner. His recommendation was to support the review, which is what the FPA pushed for and the AFA pushed for, was that the review that already exists and is to be carried in 2021 should be allowed to be taken out, to be conducted before any further changes are made to life insurance. The Commissioner has expressed his desire that commissions should go to 0, but again, that's not his recommendation. The government has supported the recommendation to do the review, but it should be noted that the government's position is if there was going to be a change, their preference is level, and of course the opposition, Labor, are in a position where if, depending on the review outcome, their position would be a nil commission position. So we know which side of politics and where they stand. Our obligation now is to ensure that the review done in 2021 is actually done properly, and we know what the measures are. So what are we actually looking for, and what are the measures of success that would say that there is no change needed, or if there's change needed. So that's the important focus from this point on, is actually getting that review, the scope of the review, the process of the review, and industry participation in the review. The other change, which is in relation to restrictions on fees from super. So this twofold here. One is that advice fees can no longer be deducted from my super accounts, with the only exception being intra-fund advice, which is allowable in my super to be collected by the members of the fund. But for outside of intra-fund advice, fees will no longer be able to be deducted out of my super. It doesn't mean you can't charge the client for the advice, it just means it can't come out of the my super account. And the second thing to point is that the Commissioner made note about, in his eyes, the lax definition of sole purpose test being used in the profession around collecting fees out of super in general, around advice and meeting the sole purpose test. So he hasn't changed the sole purpose test, but he's definitely put a question mark about the interpretation of industry of the sole purpose test, both from the trustees and the advice sector. And what's interesting to note there is that he's putting an onus back on the trustees to actually sign off on the fact that the advice given and being charged for out of the super fund meets the sole purpose test. I think the scarier thing for us is that his definition of the sole purpose test, is that only advice against that product itself, that superannuation product, can be charged from that super fund. So it can't be a more general, if you like, definition of sole purpose around superannuation retirement benefits in general, if it relates to advice on other superannuation products. I think that's quite interesting. I don't know where that's going to go, but again, it's interesting to note that trustees are likely to be much harsher and also more involved in their acceptance of advice fees coming out of their members' accounts and playing a bigger role in that space. Just in terms of the grandfather commissions, I just thought I'd share with you some data collected by the FPA through our membership, which we completed at the end of last year. And as you can see here, the majority of revenue earned by FPA members is fee for service, which is fixed pricing, followed by asset-based fees. Commission from risk insurance is about 18%, and commissions from non-risk, this is the grandfathered commissions that are at risk. In the FPA membership, the average is 8.3% of their remuneration comes from grandfathered commissions. Now, obviously what that means is there are a number of our members who have less than 8.3% and a number of our members that have more than 8.3%. But I don't dispute the fact that we have some of our members who have a large proportion of their revenue coming from grandfathered commissions, which I acknowledged does exist. But on average, as you can see, it is a small proportion of their total remuneration. Further, interestingly, when you look at converting those clients into fee-for-service clients, the average in terms of fee-for-service arrangements around statements of advice and ongoing fees, as per the membership, is as follows: 2,400 upfront and 3,300 ongoing is the average charged by the profession at the moment through the FPA membership. And fixed price is the most common form in terms of how fees are calculated, followed by asset-based fees. Interestingly, the hourly rates is starting to increase a lot more. It didn't exist a number of years ago, so there are changes, as you can see, on foot in terms of the calculation methodology. And this one, in terms of the collection, investments and platforms is still the number one, and obviously superannuation funds. So this goes to my point that I raised earlier about the recommendation and the stricter impost, if you like, that the Commissioner is placing on trustees to verify, if you like, or sign off on fees coming out of superannuation. As you can see, that will have a direct impact on super funds, collecting money from super fund potentially. But as you can see, directly from clients is 51% now. So that's a larger proportion than existed previously. I want to touch on the disciplinary regime that was recommended. I said this earlier at the start of the conversation that the disciplinary regime is something that was concentrated on quite heavily in the recommendations of the report. And the key point here was that to have a cohesive disciplinary system. He has recommended effectively a few changes that you should be aware of, but not necessarily a direct impact to you personally as practitioners, but you should be aware because indirectly there are some changes here or potential changes subject to the adoption of the recommendations. But effectively, he has touted a single body to be introduced to manage, I suppose, the overall bannings of financial planners. You know, again, he hasn't prescribed how that would be done and how that would work really in the current system with ASIC licensees and the introduction of code monitoring schemes who are designed to monitor and supervise code of ethics, which I'll mention in a moment. But reference checking and misconduct identification by licensees is now being, you know, questioned and said that there has to be a uniformed standard across the whole sector, as opposed to the current methodology where each licensee does their own thing. So that's going to come out, I think, quite heavily and will be imposed on all licensees in terms of that, the reporting obligations as well. So I think you're going to find a more aligned process, and this is going to be really important because the register now does show us those individual advisors who are potentially license hopping, and if you are going from licensee to licensee, you know, those licensees are now going to have to comply with stricter standards in the reference checking than perhaps was the case before, and it's designed to try and ensure that people aren't escaping scrutiny in terms of license hopping. And also the reporting of conduct or misconduct, etc. Now, you know, again, he's acknowledged the fact that there's been perhaps misinterpretation or different interpretations of that under the legislation, and is requiring that again to be simplified, and that there is no questions about when to report and what to report. I should also point out that a single regime is something really important to the FPA. Under code monitoring, which is currently legislated and required that all financial advisors will need to register to a code monitoring scheme effective from the 1st of Jan 2020, you'll be subject to a code monitoring body. The FPA has signed a cooperation agreement with these associations that you can see on the screen to create a single body. Again, you know, this goes to that principle of having a cohesive model, and so as a result, these associations have agreed to work together, and we're in talks with other associations to join that as well. I think it's our intention that there is one single body that will do the work, as opposed to multiple bodies where different standards and different interpretations may exist. So keep a lookout for more information to that on that to come. External dispute resolution and compensation. Look, effectively here, I mentioned this already, a recommendation on compensation scheme of last resort has been made. Both sides of politics are supporting this. Powers have been given to AFCA to go back 10 years on retrospective complaints. And so you'll hear a lot more from AFCA about that process and what they're doing. And they are encouraging people not to destroy records beyond 7 years. So where this gets complicated is that when you go back 10 years, for many of you, you won't have records beyond the compulsory 7 that you have to keep. And that's because you shouldn't be keeping records beyond the requirements of keeping those records. And so, but what AFCA are asking is that you do not destroy records beyond the 7 years, and try and keep hold of records that may be 10 years old, because they will be actively taking complaints that may relate to advice given over the last 10 years. So just be aware that that is happening, and there'll be more communication from AFCA around that. The big issue, of course, of the compensation scheme of last resort is going forward is what the model is and how it's going to be funded. And we have grave concerns about this being a costly exercise if you don't sort out some of the issues in play today about the existing PI market. And we'll continue to advocate that. Now, I'm going to I'm going to pause there. That's the Royal Commission, and there's a lot of content there that we've gone through. And I know there's a lot of questions that have come through, so we're going to pause and see if we can answer some questions around that at the moment.
Yeah, thanks, Dante. I really appreciate it. There's a lot of information in there, and hence we're getting a bunch of questions through. Thanks for sending them through. We'll try and get through as many as we can. Dante, just wondering, when you express the FPA's views, were the financial members consulted or asked their opinion, and how's that collated for the FPA to form these views, or do the FPA form these views without consulting the members? Appreciate your comments.
Yeah, no, thank you. I mean, at the time when we did the response to the Royal Commission, that work was done through the board, for the FPA board, which were representatives of the membership base, but also that work has also continued through our committee structures. So we have formal policy committees and professional standards committees where these items are discussed. Admittedly, there wasn't a massive survey that went out asking that particular question, but we also do that on a number of fronts where we utilise the committee structures where members are represented there, and through formal submission process to members about getting feedback. One of the things that we'll be doing is doing a survey to all members about the final recommendations that have come out to get membership views around the different types of recommendations, which will include the grandfather commissions as well. But I suppose to answer your question, that was formed by the FPA board, which are your representatives.
Thanks very much. You did mention a lack of coherency around disciplinary action. So similar to your approach on code monitoring, are you working with other industry bodies to provide clearer industry advocacy to government? And then further to that longer term, can you expect there to be consolidation of professional bodies in the future?
Yeah, good question. And the answer is yes, primarily around the working together. So in particular, you know, the AFA and the FPA, and I've worked quite closely with Phil Kewen. We've actually gone to Canberra together and represented together the profession to a number of backbenchers as well as the minister himself. So we are doing that a lot more proactively now. And also I've spoken to the AFA about setting up a joint task force on the life insurance review to work out the review scope for the life insurance review June 2021. So we are actively talking together about doing some joint work in the advocacy space. So that's definitely on foot, and we'll do that with other associations, that, especially those that I showed on the screen who we've signed a cooperation agreement with. In terms of what that means for associations, amalgamating, etc., well, that's really a question for the membership and for the boards, respective boards and membership, because that's not a decision I can make. But, you know, anything could happen in the future.
So it's sort of two questions here. I'm going to roll into one and keep these coming. Thanks very much. So one of the questions is, look, this is all very well, but how is making user pays going to encourage more people to engage with advisors? And another question that's come through, similar topic, who is actually responsible for educating the public that it's going to become more expensive, potentially inaccessible for some to receive quality advice as a result of the RC, just things like higher education, reg, insurance, business costs, and then the social impacts of financial advice that is inaccessible to that large group. I mean, who do those people turn to? What's your view there?
Yeah, look, that's a very good question, and it's something we need to continue to advocate for. I mean, one of the things that, you know, we haven't lost sight of the fact is that under the FOFA reforms, one of the objectives of FOFA was actually accessibility and affordability of advice. And I think it'd be fair to say I'd get some universal consensus here that actually hasn't happened, and we acknowledge that. And nothing here indicates really none of these recommendations really go to the heart of improving accessibility and affordability directly, but indirectly I think they will. And I think it's a combination of things. One, we need to go through some reforms and actually get these changes to occur, which are costly and will require an impact cost on businesses. But two, on the other side of these reforms, you also need to advocate for where duplication, red tape, and unnecessary reforms can be removed and repealed, so that the advice and the process of delivering advice can also be reduced in cost as well. And then the role of technology. I think it's fair to say that, you know, technology is going to play a bigger role in how do we access the masses. And it doesn't mean advisors aren't involved there. It's the way advisors can use the role of technology to help access or provide advice to those otherwise that can't afford it. And I think the final piece that I would say is that we continue advocating for some form of subsidy or financial support from government, because to your point, there will be people that will need advice that won't be able to afford it without some form of government assistance. Now, in the legal profession, we have legal aid as an example. You know, in finance, there is financial counsellors, but that's for people that are effectively in crisis. There's probably a gap between financial planning and financial counselling that would require some form of government subsidy or support, which we would advocate for. And that could be in the way of tax deductibility of advice, with being means tested, some form of rebate that could be afforded to those based on a means test approach to get advice. So, you know, we are concurrently advocating those things in order to ensure that accessibility and affordability advice does improve going forward. But I accept the notion of that question where, you know, all these reforms and changes are doing nothing but increasing costs and removing accessibility. So we do need to be mindful of that, I agree.
A lot of questions coming through on grandfather commissions.
Yep.
And, you know, people have purchased book with grandfather commissions and that sort of stuff. I mean, I'm keen to get your comments on that, but also one of the questions that's come through specifically, do you see grandfather commissions applying to corporate super schemes that have contribution fees only?
In that, them ending, is that the question? So look, basically the recommendation here is for all anything that's under the grandfathering provisions. So this could, you know, it would need to technically look at that. But if they're caught under the grandfathering provisions, then yes, they would go. But if they're not, then and I have to admit I'm not 100% sure about how this particular fee you're referring to in the corporate super sector works. But my answer there is that if they're captured under the grandfathering provisions, if they're an exempt item currently under the FOFA regime, then they would be removed under this piece of legislation.
Plenty of questions coming through. Great, Prezzo. What's your view on the wholesale client exception?
Yeah, well, good question. Nothing's been touched around that, and in fact, again, that's one of those legacy items following FOFA that never got really completed, because there was a review. There was a review conducted under the FOFA regime around the definition of wholesale retail, and we think there's a concern there. We think there's an issue around that, and of course, wholesale. If you're an advisor who purely operates in the wholesale market, then you're exempt from a number of these reforms and changes. So there's some big question marks there. I think that needs to be the next point that needs to be reviewed, is that wholesale retail definition and breakup.
Question from Paul. With all the changes coming, where do you see the licensee fees going, and how is that going to impact consumers? Yeah,
look, again, a great question. That's evolving and changing. And look, you know, I note in the press in recent times that there's been a couple of dealer groups coming out talking about subsidisation of advice and removing that and moving, you know, for the advice model to be self-sustainable. And I think that's what we're looking likely to see going forward. But what that means in terms of licensee fees, etc., I don't know. Interestingly, nothing in the recommendations themselves remove or change really the operation of licensees. However, you do need to look at some of the signalling around things like individual registration of code monitoring bodies, obviously being listed on the financial advisor register, individual obligations and responsibility for advice being taken under FOFA for best interest. So there is a heavier burden on individual practitioners to take their own accountability and responsibility for their advice. I think there is still a massive role for licensees to support practitioners. I think the models obviously will have to change. How they'll change, what they'll look like going forward is the big question mark.
Sure. We are running out of time. There are a ton of questions here. If we don't get to them, we'll certainly provide these to Dante as well so he can come back to you. Here's a really important question. I think a lot of people, this has been on the mind of a lot of people, and that is, do you think that the values of business have fallen as a result of a lot of these changes?
Well, again, from what I've seen and the people that I talk to, that answer is yes. Because of uncertainty, I think is without doubt, and it depends on your business, and if it's obviously heavily made up of grandfathered commissions and potentially life insurance, then yes, I think there'd be some uncertainty around the value of those businesses. But also I think in general financial planning businesses, the trend has shown that the multiples and the values have been declining and changing since the pre-FOFA versus post-FOFA regimes. And look, you know, I think if you look down the track, I mean, you've got to see that the financial planning businesses are moving towards similar pricing multiples and valuations of accounting and legal firms going forward.
With only a few minutes left, any closing comments? Dante, you've got through a lot today, and I think the key point is there still remains a lot of uncertainty.
Yes.
Even with that, obviously the election hanging over like a cloud, and that's creating uncertainty. You're seen as a really respected leader of our industry. What's your one piece of advice that you can give to people who are part of our webinar today about where we're going over the next 6 months?
Look, it's probably hard to take this, but it's the opportunity. I mean, and it's hard to see it, I probably should say, rather than take, but it's actually look at the opportunities. I really look at this and say, yes, and then we have to make sure we do this properly, and we have to do this respectfully, and we have to also make sure that these are workable outcomes. But make no mistake, there are opportunities for everyone in the profession to actually thrive from these changes. And that does mean working on your own businesses and models and looking about what be the best fit going forward, you know, your clientele and what types of clients and advice businesses you want to run going forward. So it's not going to be easy, but I strongly believe that the opportunities are going to be great, especially as we go through this reform. So where possible, look for the silver lining, because there is a niche and there's an opportunity. And, you know, even if the reports are true that there might be some reduction in advisor numbers, that doesn't mean that the need and the demand for advice won't continue to increase. So we need people to be available and willing to provide advice to the Australian public, and that means you, and we need more of you.
Fantastic. We really appreciate your time. You've covered a lot. There's still so much to cover. We could sit here all day. Really appreciate it. Listeners as well, we want to say thanks very much for joining us. We hope you found the session valuable, enjoyed the presentation, and appreciate all your questions coming in as well. There are many that we could sit and answer as well, and we'll endeavour to do that by passing them on to Dante, and obviously feel free to make contact. Just as a reminder, to receive your CPD points, you'll need to complete the feedback survey, which should appear when we end this webinar. We'll run through a few more slides, and then we'll wind it up.
Oh, look, there are a few more slides to go, but I'm conscious of the fact that the topic here is around fascia that I wanted to go through, and it's just really giving an update as to the fact that those standards are now in place, and I suppose really the point I wanted to make here is those standards are in place. There's a lot of misunderstanding or confusion in the marketplace about some of those standards and where they're at. So, and also what members are asking for in terms of support, and the exam preparation and the education requirements of obviously our primary focus, and also what recognition I'm getting from my existing studies. So that's what's come out from the members. I just wanted to point out here that we are literally launching tomorrow our FPA Return to Learn tool, which effectively will be available to all members free of charge to go in and access all the support material around fascia and the education standards. It will include tools to determine your actual pathway, so what study do you need to do, and also access to tools and resources to help you if you are someone that is, you know, hasn't been back to university or been to university for a long time, to prep you for that. And the final thing that I wanted to mention about that is that one of the difficulty challenges you'll have for those of you that do need to do some study, and in fact everyone will have to do study because everyone will have to do at least the Code of Ethics study, but for everyone that needs to do the study is actually your research into the different courses available. And what we've done here is we've basically obtained all the information of all the postgraduate courses in the marketplace that's been approved by FASCIA, and put it together for you in one place so that you can actually look through and decide between which university you want to attend. You know, we're comparing prices, we're comparing the offering, we're comparing the credits and RPL that's available. So this is a tool free for members that will be launched tomorrow, and will also help ensure that all the information about FASCIA is explained to everyone, because as I said, there's a lot of misinformation about what that means for you. So I just wanted to make sure that everyone on the call who's an FPA member is aware of that, and to make sure you interact with it and engage with it. So thank you.
Good on you. And speaking of resources, You might be interested in some of the other events that are coming up. We're currently at Netwealth, we're currently touring Australia to share our alternative technical strategies to really help you get the most out of super for your clients. There is still a number of limited spots available. Have a quick look at our website for details there. Coming up, we've got a CPD portfolio construction webinar with Amit Loader from Fidelity, who's going to be sharing a few tools and methodologies that Fidelity uses in assessing a company's quality. Couple of key points I just want to finish on. At Netwealth, we've worked with some of Australia's leading innovation experts to create a collection of downloadable resources, workshops and tools to try and inspire creativity within your teams. And they're really simple. They're team building exercises. They've been designed to help your business see innovation differently. Jump on the website, as you can see here. We hope you download them and find them useful for whatever challenges you're working on at the moment, and we know there are plenty. Further to that, Netwealth, in partnership with Banker, is bringing financial literacy to over 15,000 Aussie kids nationally. It's really cool. Banker transforms the classroom into a virtual economy where students have their own online mock bank accounts, transacting with one another and their teacher. They experience budgeting, taxes, super, mortgages, and much more in a really hands-on, safe and controlled environment. What we're trying to do is help improve the financial skills of young Aussies by doing this program. Feel free to contact Netwealth or visit our website to refer a teacher. We hope to see you next time, as Netwealth's very own Keith Shue is going to analyse the impacts of the federal budget. We'll have all that for advisors and clients. Thanks so much for joining us today. Dante, thanks again. We really appreciate you making the time.
Thanks for having me. Really appreciate it.
On behalf of Netwealth, have a wonderful week. Thanks again.